Hello, everybody, and welcome to today's webinar. Just want to let you know, got several hundred people signed up just this morning. I see the numbers ticking up really fast here. Probably going to give it about 60 more seconds, and we'll go ahead and get started. Just want to let you know that you're in the right place. Hello, everybody, and thanks for joining today. My name is Mike Vinoy. I am the head of marketing at Assure, and anxious to talk about today's topic for our weekly webinar series on this whole COVID-19 response and all the major legislation and stimulus programs that have resulted. So today we're focused on maximizing PPP loan forgiveness. If you attended our webinar 2 weeks ago, we first touched the same subject. If you attended that, don't worry, this isn't going to be a complete repeat. We're going to do a little bit of an overview on some of those same topics. But since then, there has been more guidance from the SBA. Specifically, last week, we actually got the real application for forgiveness from the SBA, but we also had clarification on some really important items. If you remember attending 2 weeks ago, we talked, here's what we do know, here's what we don't know. So there are still plenty that we don't know, but some of the big pieces of the puzzle have snapped into place, so to speak. So without further ado, let's go ahead and jump in. So what we're going to talk about today and what we're not. So what's in, we're going to talk about a really quick recap, high level over the PPP and the EIDL loans, what they are, what the difference is, because there's still plenty of people who haven't applied yet, and especially to the EIDLs. We're going to talk about the rules for getting your PPP loan forgiven, and we're going to talk about the SBA updates. So what's not? So as we talk about how to quote unquote maximize your forgiveness, this is not some tips and tricks. We're not out here to scam the government. We don't want anybody else to try to scam anybody. This is taxpayer money. This is our money, right, that is going to help respond to a crisis we've never seen before. So this is not how to game a system and any tips and tricks. This is simply to understand the rules because it's complex. And then today we're going to talk about what the rules are, how to maximize your PPP loan forgiveness. But then next week, we're actually going to go into real life, next webinar, next week is a holiday week. So in 2 weeks, our next webinar, we're going to jump in to the actual application itself. We're going to go step by step, actually how to fill out the application. As people, the earliest people started getting funded for PPP early to mid-April, their 8-week clocks, so to speak, are going to be coming up due really right after the Memorial Day weekend. So people will start to begin filling out these applications. And even if you haven't been funded yet, or even if you haven't applied yet, really important to understand the end game. Because it will probably should drive your strategy and how much to apply for and how you need to be thinking about spending the money. Because the application reveals a whole lot about specifically what those rules are that we're going to talk about today. So as always, a little safe harbor statement. We're not your CPA, we're not your lawyer, we're not your bank. We are very experienced Payroll HR folks at Assure. We live and breathe this stuff. We do actually work with other payroll companies. So there's an organization called the NPRC, the National Payroll Reporting Consortium, where we partner with all the household names in the payroll HR industry. in provide advice and consultation to Department of Labor, to the IRS, to Small Business Administration, because as you can imagine, Congress passes these giant sweeping laws, right? FFCRA, the CARES Act, as well-intentioned as they may be, they don't really understand always the unintended consequences, and they don't understand necessarily the nitty-gritty how to actually implement and execute these new laws. And so that's what the function of this nonpartisan group, the NPRC, is, where we have a board seat in this organization to really not just have a seat at the table to understand what's going on, but to really even drive policy. So it's from this position of authority that we speak from, and knowing that all these laws are, the PPP, it deeply impacts payroll, right? So we've made modifications to our platform for our customers to be able to report on all this and stay compliant with all this legislation. So we think you should always consult with your CPA, always your banker, always your own attorney, but we are going to give you the very best advice and guidance that we can. Okay, so with that, what are the small business stimulus sources? There's really two big buckets here, right? And so I think most everybody knows by now, it's somewhere really close to 75% of all small businesses have already applied for PPP, but you're talking about, some 5-6 million small businesses, and a quarter of them haven't yet. So you're still talking, a big number of companies who have not yet applied. Knowing most of us already have, I'm going to go quick here. So the two programs, the Paycheck Protection Program and the Economic Injury Disaster Loan, the EIDLs. So the Paycheck Protection Program, the name says it all. It's exactly what this program is designed for. It's to protect paychecks. So rather than, as businesses face economic hardship due to the COVID pandemic, how do we get people on payroll and off of unemployment, right? So that's the goal. And so if you think about the first row there, can the money be used for? Well, 75% of the money's got to go to payroll, but you can spend some money on overhead, interest, rent, utilities, etc. For the EIDL loans, you can use that money really for whatever business needs you want. Certainly it can be payroll, but it doesn't have to be. The next row down, how much can you borrow? So you can borrow up to $10 million in the PPP program, not more than 2.5 times your average monthly payroll. For EIDL, you can borrow up to $2 million, so it's less, but you can borrow that up to a 30-year period. And how expensive is this money? Row 3, PPP money is inexpensive money. The ideal situation is that it's free money. It really gets converted into a grant, which is why this is so attractive and which is why most everybody's here today. But the EIDL, that's 3.75, that's not expensive money. So if you don't have all your needs met through PPP, you can and should still apply for an EIDL loan to get you through. If your business is shut down, you can't make the rents, can't make the lease payments, and that constitutes more than 25% of your overall expenses. So therefore, it's not going to be forgiven by PPP. By all means, you should pursue that, and it's reflected in the terms, right? So PPP, 2.5 times a monthly payroll, 1% interest for 2 years. EIDL up to 2 million, 3.75% up to 30 years. And PPP can be forgiven as a grant. The EIDL is purely a loan, right? I think the single biggest difference that everybody needs to be aware of, even though they're both SBA, Small Business Association backed loans, with EIDL, you are working directly with the SBA. You can't fill out an application with a bank, any bank, to get an EIDL loan. You have to go directly to the SBA website and fill out, just as you would with most lending institutions, you're going to fill out a loan application, put all your supporting documentation, and upload it, supply it right directly to SBA. Huge difference with the PPP. It's an SBA-backed loan, but this is going to be through your bank. The SBA acts kind of like FDIC, is an insurer almost of these loans to supply the reimbursement back to the bank for the forgiveness of these things. So why is that really important? It's really important because there are several thousand banks that are participating in this. Just jump to some of the numbers. what is it, 5,000 as of what was this, the 16th? This was as of Saturday. 5,496 lenders. So over 5,000 banks in credit unions are participating lenders here, right? So what does that mean? So we have the SBA as a singular entity. There's one singular set of rules for the PPP. Lots of guidance always coming out. These IFRs, the interim final rules, as they continue to clarify. If you hop on their website, there are a few dozen updates and FAQs already provided, because every couple of days there's something new that gets clarified or changed. So this whole thing's fluid, number one. And then number two, just more importantly, you are the one getting the loan from your bank, not directly from SBA. So even if your bank interprets the rules differently than another bank, God forbid, maybe they interpret them incorrectly, it is up to you to work with your bank. So if your bank requires documentation XYZ that you don't think is required by the SBA standards, doesn't matter. It is up, this is a lending relationship between you and your bank, and if your bank has more stringent guidelines, they can add on whatever requirements they want, because they are the ones who are going to have to certify that you are following, that they're letting the money to the way it should be lent, that the money is being spent on what it should be spent on. And they're the ones going to be on the hook if you default, right? If you squander the money, or God forbid you go out of business, they're the ones who are going to have to provide all the documentation. And a lot of these are small community banks, that this is a gigantic burden for not a heck of a lot of money. They're not making big money on 1% interest loans, right? So depending on the risk aversion of your local bank, and just culturally and technologically how advanced they are, the reality is this is gonna vary a whole bunch bank by bank. So you're gonna hear me reference that a whole bunch. So big picture, pretty much all small businesses are gonna get funded who want to get funded. You know, 3/4 of everybody, 74.9% have already applied. About half of those have already received their money. The rest, most of the money is earmarked. The fund is on tranche number 2. Of which about half of that money is still left. So there still is plenty of money left. So if you haven't applied, by all means, for sure, you should be applying for these PPP loans. Okay, so when we first kicked this off a few weeks ago, we basically said there's 3 buckets to forgiveness. It's the 8 weeks to spend the money. We listed what the qualifying expenses were, meaning what could you spend money on. 75% had to go to payroll, and then the rest could go to things like rent, utilities, interest on mortgage. And then if you followed the rules, you know, up to 100% of your loan would be forgiven, so long as you spent that mix 75-25 payroll and overhead. And so what we did a couple of weeks ago is go into more the details. What I'm going to do today is I'm going to review the fundamentals of the program, which haven't changed. But what I'm going to add on is what has been newly updated from the SBA just last week. So Thursday and Friday, there was new guidance that came out. So in the yellow is the first thing. That this is really unchanged, but there's been some additive here, and this is really, really important. Okay, so the 8-week clock. So the way the law was written was that the 8-week clock starts ticking the day you get funded. So in this example, I got a calendar here that if you got funded on April 30th, Thursday, April 30th, that means you have 8 weeks, 56 days to spend all of the money, and that will be your comparison period. That will be what they call the covered period. And so basically your time to spend the money is between the 30th and the 24th. Now, this is one of the most controversial areas of PPP loans, is that many businesses are shut down during that period, right? You might be in a state order or a city stay-home shelter order that you can't even open your doors. And so if you're, maybe a software company or a business services company and everybody can work from home, this has an opportunity to be an incredibly stimulative program for your business, right? Because you're still paying your employees, you're still providing services to clients. The world that got upended, how you went about doing that, but because you could continue to pay your people and bring people back if you had to furlough anybody, this is essentially free money. So an incredibly stimulative program. if, however, you are a restaurant and your revenue just fell off a cliff. Maybe you're doing curbside, but your staff is 10% of what it used to be. Your revenue is 5% of what it used to be, right? To bring everybody back, you would actually be paying the federal portion of your taxes while you're burning through your PPP money, and it could actually end up being a bit of a penalty to you because you don't have the revenue to offset that expense. So definitely one of the most controversial things, and one of the things that we were giving guidance early on to be really cautious about how you do this. So if you're one of these people who have not yet been funded, so 75% have applied, half of those have been funded. If you haven't been funded yet, and you are still in a shutdown order, and work with your bank. The bank you might already have an SBA approval number. And so the rules are the bank's going to have to fund you within 10 days. Work with your bank to push that funding date out as far as you can, and so that the 8 weeks at least overlaps the time when you're going to have the most revenue to offset that, because that's when you can afford to have those employees. It's when you're going to know how to maximize that offset. Now, last week, SBA came up with some new guidance that is a very, very good thing. So it's the first thing, the alternate payroll covered period is how they state it. And so what this says, as you can imagine, if you got funded on Thursday, April 30th, well, whose pay period starts on a Thursday, right? Almost nobody. So most people are going to be weekly, starting on a Sunday or a Monday, or maybe bi-weekly starting on a Sunday, Monday. Maybe you're a first and 16th kind of a company, but most people are going to be weekly, bi-weekly, pay periods starting on a Sunday or a Monday. So what the SBA came up with here is you have a choice as a borrower that either stick with the original plan, your clock starts ticking on the day you get funded, or you can choose the first day of the following pay period, the first day of the pay period following the date of disbursement. So if you had a pay period in this example in the orange that was on May 11th, you got funded April 30th, but the next pay period starts on May 11th, that essentially bought you almost 2 weeks, a solid week and a half of extra time during perhaps a shutdown. At the back end of that, if you see instead of your forgiveness period ending on the 24th, in this case, it would end on the 5th. That would, during a time presumably when you're open for business, because most of the shelter orders will have been long gone by early July. This could be a gigantic opportunity. So if you're in a situation like this, you got a bi-weekly payroll, and you didn't get funded on the first day of your period, you're going to have at least some opportunity to choose this alternate payroll covered period. They will buy you a few more days of open business, not under shelter order, to maximize your loan. The other thing, the bottom right here, cash versus accrual. This was still an open issue. SBA has given guidance on this topic. The fact is, it can be either. So if you don't know what accrual means, just think about incurred, paid versus incurred. So that means if it's paid or cash, those would be the amount you actually wrote the checks and had your either ACH transaction to fund the electronic payroll, or you handed checks to the employees, paper checks to the employees. So that would be what you paid, or the cash accounting, right? And so you can choose cash accounting within your 8-week period, or you can choose an accrual method, which is the incurred, right? So if that pay period starts on May the 11th in the orange top left, and that pay period runs through, let's jump in, so through a 2-week period. So the May 24th would have been the last day, and your check date was on, say, the 29th, that following Friday. That would be a pretty common scenario, right? If you wanted to go cash basis, it could be the 29th, but then you're going to have to do cash basis for all of the 8-week period, or you're going to do through the 24th, the accrual period. Whatever you do, just be consistent. While they haven't explicitly said it, I've read plenty where people theorizing, hey, can I use accrual for the end of my period? Can I use cash for the beginning and kind of double dip? I think just follow common sense. General rule of thumb is they're going to do their best to avoid any kind of double dipping. This is taxpayer money. They don't want to be taken advantage of. So whatever method you choose, incurred versus paid, cash versus accrual, just be consistent with that method. Okay. I mentioned this is the most controversial topic. So do not take this to the bank. We are not saying this is going to happen, but certainly at Assure we are advocating for small businesses. And if you're a company that is impacted and has been shut down, this may be the single most important topic to you: is do you get to take advantage of your full 8 weeks or not? And I'm going to get to the really important why of that calculation in a second. And on both sides of the aisle here, so not being political, whether you're lean red or you lean blue, the bill in the House right now that already passed the House, excuse me, the HEROES Act, the $3 trillion pandemic relief proposal. Well, it seems unlikely it's going to pass the Senate. It has provision where it already converts that 8 weeks into 24 weeks. On the other side of the aisle, in the Senate, there seems to be already bipartisan support for carving this out as a singular bill. And extending to, could be 24 weeks, could be 26 weeks, but it's something larger than 8. So this is not law. There's not a bill that's been passed waiting for anybody's signature, but there does seem to be building consensus. So I only say that to give some, I can't even call it guidance because there's nothing you can act upon today, but maybe some hope for small businesses. As of right now, you got to live within the rules. And the rules are what we talked about in the previous slide. But what could be around the corner, we do think that there's a pretty good chance additional relief might be happening in this area. Okay, so now here's why you might not want to overreach in how much you borrow. So if you're a company that you got your loan number, you haven't been funded yet, or you're one of the 25% who hasn't applied yet, think through how much you're actually going to borrow. So it has everything to do with whether you are in a shelter order or not, and whether you're still actually can be open for business and therefore even spend the payroll dollars. So let's walk through this example. In either case, this is a sample company where the monthly payroll is $100,000. So whether you're going to max out your loan or take a small loan, the factor is the fixed factor is that your monthly payroll is $100,000. Now in the middle column, max loan, if you took the max loan available through PPP, that's a factor of 2.5, right? So that's a $250,000 loan, of which highlighted in yellow, 75% must be spent on payroll, $187,500, right? Now, if you're in a shelter order, so think through the logic, 2.5 times your monthly payroll. Well, if you're only going to be open for say 3 of the 8 weeks because you're under a shelter order, there's no way in heck you're ever going to spend, two times a monthly payroll on payroll dollars, right? So therefore, your total forgiven amount might decrease. Now, the amount you spend on payroll, we're going to talk about what those exceptions, what those provisions look like. It's not binary. It's not either you get forgiven or you don't. Basically, what you spend on payroll, essentially, you're going to get forgiven, but you have a chance to get your overhead forgiven also. So it's worthwhile putting some effort into trying to calculate what the right amount to borrow is here. And so if in the same example, same company, that $100,000 payroll, if we look at the far right column, smaller loan, if you only took a 1x instead of the allowable 2.5x and just borrowed 100,000 instead of the 250, that means you've only got $75,000 to come up in payroll expense versus 187.5 to come up in expense. You might actually do that, right? If you're open for say 3 of the 8 weeks due to the shelter order in your local community. And if that's the case, that 25% on other allowable expenses, that could be forgiven. And for most small businesses, a $25,000 gift versus a $62,500 loan, a $25,000 gift, most people would take all day long, right? So I won't belabor the point because we're getting out there. But if you have not received your money, talk to your banker, see if you can make an adjustment if it makes sense. If you have not yet applied, get off your butt and apply. It's too important not to, but take this into consideration. Okay, so what are the forgivable expenses and how we've broken this out? If it's black and white, that's what we reviewed a couple weeks ago. Orange means it's been updated, and if it's blue, that means there's still some unknowns. So 75% of the loan has to be spent on payroll. So it starts out, as we know, it's a loan, right? The goal is to get it forgiven, therefore it becomes a grant, but it starts out as a loan, right? So no matter how big your loan, whether you took the full 2.5x or you took some smaller dollar amount, 75% of the loan must be spent on payroll. And I highlight loan for one other reason. It is not of the money you spent. So we were a couple of weeks ago, got some Q&A at the end of this session where people thought it was, okay, if I borrowed $100,000, but I only spent 50 of it, and 75% of that 50 was on payroll, do I get anything forgiven? And the answer is no. It is based on the entire loan amount. It is not just on the dollars that you spend. You don't just get to give back the extra money and then balance out what's left. So this is 75% of loan has to be spent on payroll. And then no payroll can go over $100,000 a year per person. So you can't spend more than $8,300 a month. What is $3,800 a week? Per employee. And then what goes into that 100,000? So what's included is employer paid health insurance. You can have retirement, just the matching portions for it. So the employer expenses. And even local and state taxes, which would include unemployment insurance, right? So what's excluded is the federal portion, Social Security, Medicare portion of those taxes. So the goal is that anybody who's making 100,000 or less, that these tax dollars go to keeping them paid and feeding their families. The idea is not to further enrich highly compensated owners or highly compensated executives at these companies. So if you have a person who makes 125,000 a year, the first 100,000 counts, but the remaining 25,000 does not. So there's still a stimulative component. It's not binary, either that person's payroll is covered or not, but it's the first $100,000, if that makes sense. Okay. And then if you're a small business, maybe you're a partnership, or just maybe it could even be a one-person company, right? Regarding owners' compensation and draws, that's really just going to reflect what you have in your tax form, right? So if you're an LLC and you're taking normal payroll like the rest of your employees, it's going to be based on your W-2, and you can actually you'll show up in the normal 941s and the tax returns for the business. If you're a sole proprietor, it's going to be based on your Schedule C, line 31, which is basically your net profit or your net loss. That's what's going to show up for what your personal income is and what can be drawn. And it's going to just have a look back comparison to 2019. So what's new in the orange? Yeah, or new, or at least clarified. We already talked about the first one. This was a big one that was an open-ended issue. So the expenses can be cash or accrual, paid or incurred, but no matter what you do, you have to be consistent. You can't do a combination thereof just to try to squeeze more money into that time period. Either use cash accounting or use accrual accounting. And then payroll costs, just further clarification, it's really anything that is in wages, so salaries, wages, commissions, tips, that's all part of compensation. Now, there's still this open question that there's a lot of chatter on the internet around bonuses. And so it's fair to say that the intent of the law is to offset people's pay, right? And so if I think that if we were going to give guidance, and you should certainly consult with your CPA and your lawyer, at the end of the day, it's going to be your bank who makes this decision, what is forgivable and what is not, because they're the ones that are going to have to certify. If you've never given a bonus in your life and all of a sudden you're given bonus for some suspicious sounding reason, then it's likely not forgivable, right? It's not included. But if you're a company who gives bonuses and that's just part of the normal compensation, just the way some people have tips and commissions, then that would seem completely reasonable. So it's in blue because there is not specific guidance from the SBA on this topic. I would just say in our conversations with people in the industry, we would just say pay people like you normally pay them, and that will count, and that is safe ground. Okay. Non-payroll expenses. So we've gotten some good important clarifications here. So of the 3 buckets, rent, utilities, and interest. Let's first talk about rent. So no change. The first bullet, payments under a lease agreement, it's got to be enforced before February 15th. So you couldn't have all of a sudden have the pandemic strike and then you go sign some new agreement. If it's a lease commitment, a rent commitment that was binding and in place before February 15th, it counts. And really important, there was an open question for those of you who attended the previous session on this topic. It was an implied suggestion by many that rent meant real estate, but it's been clarified that rent could be on personal equipment also, not just real property. So it could be rent on a copier lease, could be rent on a vehicle lease, could be rent on a piece of machinery for a manufacturer. So you still have to back into the 75% of the dollars going into payroll. But if you're looking for qualifying ways to spend the money on other big ticket items to get relief, that's really, really good news. What is unclear is prepayment, and you can see prepayment for rent and utilities as an open item. Kind of like the accrual accounting and cash accounting. I think it's fair to say you can't intentionally prepay a bunch of money to try to get it forgiven, but just the nature of some leases, you're prepaying versus paying in arrears, right? So get kind of the concept of, are you top of the month paying for your cell phone use for your X number of minutes and data for the following month? Or do you use the phone all you wanted, and at the end of the month you got a bill for it? So it's a little bit of an open-ended issue whether the technicalities of prepayment versus rent versus payment after the fact as it relates to the contractual nature of those agreements. But I think just we would guide towards common sense. If it smells at all like you're trying to play games and trying to get more than the intent of the law, then don't do it, right? And as always, consult with your bank. They're the ones who have to certify. Utilities, really no change there. So same guidance on this whole prepayment issue, but it's straight up. It's electric, gas, water, transportation, telephone, internet, etc. So I have seen some debate, some disagreement on whether cell phones fit into that for internet use, but from everything we can interpret, that they are and can be included in utilities, if that is an ongoing normal expense that you have in your business. It wouldn't be something you could just add on if it wasn't something you're already doing. The last, and this is a really important aspect to interest. So for interest payments, so like if you have a mortgage on your building that you do business in, you can't have forgiveness on the principal portion of that loan payment, but the interest portion, which is purely expense, you can, right? So the open-ended issue was, it's kind of like rent obligation, was that did everyone's kind of assuming that this may be meant to real estate, but they've come out and clarified this can also be personal property. So if you're a manufacturer, you've got $500,000 CNC machine that you got a 10-year note on, and you got a big monthly expense in the form of a loan payment, and half of that is interest, that would be deductible because personal property does count. So the interest portion of any loan or mortgage is now clarified to cover. So that's really good news for small businesses. Okay, let's jump into the calculations of these things. So there's two ways your loan is going to be looked at to see how much is forgiven. It's going to be the reduction of people, FTEs, and reduction of pay. That all assumes that you've spent the money on only qualifying expenses, and 75% of the money went to payroll. So the first one we'll look at is FTEs. So it's pretty straightforward, the numerator and the denominator. The top number of the numerator, it's really just the average number of employees during the covered period. So whether you're the 8 weeks from day you were funded or 8 weeks from the alternate payroll period, or if Congress passes some new law and it extends it to 24 weeks, it's going to be the number of employees you have during that time. And the denominator is just going to be the comparison period as the baseline. So if and there's really just two windows for that. And so depending on, maybe you were a business that had more seasonality, you were growing, you're shrinking, your business changed. So you really, as the borrower, have a choice of choosing February 15th, 2019 through June 30th, 2019. That would be a more seasonal, right, comparison. Or Jan 1, 2020 through February 29th, 2020, that would be more recent. So basically 2020, how many employees did he have in Q1, so to speak, as your baseline comparison. So either way, you're looking at comparing, trying to compare like windows of time, just depending on the nature of your business. So one of the things that's unclear, if we look at the bottom in orange, until last week's update from the SBA, is what constituted full-time equivalency, right? I think most of us are probably used to, in the HR world and the Affordable Care Act, and thinking 30 or more hours a week is full-time employee. They're declaring 40 hours a week as an FTE. So SBA says if you work 40 or more hours, so you work 40 hours or you work 45 or 50 hours, you're one FTE. And you can calculate it fractionally. So if you're 30 hours a week, you'd be a 75% FTE. But they've also provided for a simpler method. It kind of works out as a one-to-one comparison, that you can use the simplified method. Basically, you get a 1 FTE for a 40 plus hour person, and anybody less than that is a 0.5. So either they're a 1 or they're a 0.5 based on a 40-hour week or less than 40-hour week to make up your comparisons. So, and then the final thing is they did add an additional FTE safe harbor that says, maybe you couldn't bring everybody back in the same timing that you wanted. They have until June 30th to bring those people back. So simple denominator, how many people did you have during the 8 week of the covered period over the comparison period, and that equals your percent forgiveness. So let's just give a real life example of what that might look like. So if here are the facts. If we had an example of a loan amount of say $300,000, bullet number 2, if you spent the money the way you were supposed to, you didn't spend it on any non-qualifying expenses, you spent it only on qualified expenses, and the average number of FTEs you had February 15th, June of 2019 to June 30th was 45. And the average FTEs during your covered period was 33. So you had to lay people off and you couldn't bring everybody back on. Maybe they didn't all want to come back on. Maybe there just wasn't business to support it. Whatever the reason may be, it's the numerator of 33 divided by the denominator of 45. That's 73%. So if your loan was 300,000, the max you could be forgiven is 73% of 300, which is $220,000. So in that scenario, you'd have to repay 80 of the $300,000. Okay. Now, really straightforward. If your numerator is the same as your denominator, you had 45 employees in the 2019 period, and you have 45 employees in the covered period. It doesn't have to be the same human beings. You may have had to term someone for cause. You maybe had somebody who left and didn't want to come back, and you had to hire a replacement. So as long as they are the same number of FTEs, not the same number of named people, then you have the opportunity. If it's 45 over 45, then 100% of the loan would be forgiven in that case. The other factor, excuse me. The other factor then is wages. So two factors that can reduce your forgiveness. One is number of FTEs, number two is wages. Because you can't bring everybody back and then give them all a 50% pay cut and then get all your money forgiven. So this gets way more complex. This is a lot more detailed. And so you have to do it employee by employee, right? So this is all employees, but only the less than $100,000 portion of their wages, right? So if I have 3 employees, one makes $60,000, another makes $70,000, another makes $120,000. It's not that I just take the first 2 employees in the mix. I look at all 3, but I have to exclude the over 100,000 portion of that highest compensated example. Okay, so that's number one. And then number 2, there can in fact be a decline in compensation, but it just can't be more than 25%. So for example, if you have salespeople that work on commission, and selling might be really tough during this economic downturn, right? If they make less money, but it's not a 25% cut in income, then there's not a penalty to you as the employer. If they do have a bigger cut than 25%, which an example of a salesperson, especially if they're more commission than they are salary, that could be very likely be the case, then there might be a reduction in the amount that's forgiven. So you might need to be thinking about how do I have a comp plan that pays my variable compensation people to kind of keep them whole as the law is written and intended to do, to keep them off unemployment so they can still feed their families. How do you handle those variable comp people in a responsible way that doesn't game the system? And then, so let's just, I'm just going to take us through a couple of examples here. So I've got 5 sample employees here. I'm going to take us through covered employee number 2 and number 4, just as an example. So, and I'll start actually with, I'll do 3 examples. Number 1, so covered employee number 1. So if their Q1 wages were $14,500, you multiply that by 75% to test to see if they didn't have more than a 25% pay cut. So 14,500 times 75%, that's $10,875, column 4. And during the 8-week covered period, you paid them $11,000. That's more than they had during the other period, right? So there's no penalty to you as the employer. Employee number 2, so their Q1 wages were $20,000. 75% of that is $15,000, and you paid them $14,000. So that's less, right? So that that person, employee number 2, had more than a 25% reduction in their pay. But if, second to the last column, if you have a commitment to restore them and make them whole in their income by 6/30, there's no penalty to you. If we jump to number 4, so this is an employee who earned $24,000 in Q1. So 75% of 24,000 is 18,000. And let's say they were that salesperson, right? And they only made during the covered period 14,500. Then so you paid them significantly less than their adjusted Q1. So that's a yes, they had more than 25% cut, and no, you don't have a commitment to restore. Then the difference, $3,500, is the reduction in how much you will be forgiven. So 2 formulas for forgiveness. Number 1 is number of FTE. Number 2 is dollars. If you look in the middle of the screen there, this is quite complex. and can be difficult to get your head around. Here's the good news. The SBA published end of last week the actual forgiveness form. So what I'm going to tell you is it's just as confusing and just as difficult as this slide is to explain. But at least we have concrete. We are no longer theorizing about how the rules are going to work, because we can see the end game in the form itself, because it reveals the calculations. So in 2 weeks, we will actually go through that form and hopefully bring to life some of these examples. So, okay. So what don't we know yet? We're knowing more all the time. But this quote kind of caught my eye. Now, I don't mean to offend any bankers. It's a little bit tongue in cheek here. This guy, Tony Nitty, he wrote an article in Forbes I kind of liked. It was called 10 Things We Need to Know About PPP Loan Forgiveness. And basically he said, the banks don't know what the heck they're doing because this is completely uncharted waters. And so the SBA provides all this guidance. They write the rules. But at the end of the day, it's kind of, I'm going back to what I opened with. The banks are the ones lending you the money. They are the ones who have to certify whether you spent the money in the right way. And depending on their risk aversion, their profile, how they do business normally, there are going to be some banks who are going to just ask for mountains of paper and mountains of evidence and mountains of proof, because that's their nature. And there are going to be others that are going to be as liberal as you can possibly imagine on that spectrum. And whatever their comfort level is, and more importantly, whatever their interpretation of the law and the rule is, that's what you're going to have to live with. So because all this is done through 5,400 some banks, you are subject to, really, as a small business owner or an employer, you're subject to 5,400 some different opinions and interpretations of the law. So just never forget that. I think that always needs to be in everybody's mind here. Okay. Last thing, we'll jump to maybe have some time for some Q&A here. So this webinar has been recorded. It will be published on the website later today, first thing in the morning. And you can sign up for our next webinar where we're actually going to walk through the forgiveness application provided by SBA. So tons of resources out there, whether you have HR questions, you need links to all the states and local municipalities and all their COVID sites for all their guidance on how to reopen in your local municipality. Tons and tons and tons of resources there. We also have some product offers. We're quite literally, we are offering free HR services. So you don't have an HR department, or you're under-resourced, or you simply have questions, without a contractual financial obligation to stay, you can participate and kind of test drive our HR services, while at the same time getting real life answers from HR professionals to your COVID related questions. So sign up for a 90-day trial. If you have employees that are unbanked, you'd be shocked how many there still are out there for any number of reasons. Then when disaster strikes, hard to get people a paycheck when you're supposed to be 6 feet away from them, right? So free pay cards is an option. And if you do have to let people go, you still got to follow the law. So we have discounted services around COBRA capabilities. And I think maybe most important, our core offering is payroll and human resources software. And we have CARES PPP payroll reports that are really built right into, we've modified and come up with, just since all these laws have been implemented, these reports to help people apply if you haven't yet, if you're part of the 25% and haven't yet. More importantly for everybody else on this call, that you have the reports to run at your fingertips to calculate the information you need to accurately and properly fill out these loan forgiveness forms so you can maximize your PPP forgiveness. So with that, what do we have? We've got about 10 minutes here to the top of the hour, and we have a hard stop. I will take some questions. Let me hop into our Q&A. If you go to the GoToWebinar section, you can submit questions, and I can see way more in here than we're ever going to be able to answer in 10 minutes. So let me see if I can pull this out. Okay, first one, is cell phone considered a utility? Honestly, I don't feel like we can give clear guidance on this one. I have seen, I've read and seen completely opposing opinions from people whom I would consider authoritative. And so we don't yet have clarification on that one. I guess what I would say is I see a lot more of saying yes, it is than no, it's not. By moving the start date of our PPP loan, can incorporate 5 biweekly pay periods into our loan period instead of 4. Is that allowed? So I think the guidance we would give there. So for sure, the answer I think is always going to be here. It's up to your bank, right? Same as the previous question with cell phones. What I would say is the spirit of the law would be no. I mean, I for sure have read people's interpretation of the SBA's guidance just in the last few days, as they gave guidance end of the last week, suggesting that because you have the incurred versus paid, both are fine options, that you can do that. Just high level rule of thumb. Anything that looks and feels and smells like double dipping, I would think is going to be excluded, and you can't do it. So it would just seem unreasonable that if the comparison period is 8 weeks, that you would be able to squeeze 9 weeks worth of payroll into 8 weeks. So it's either what you paid, your cash basis, or what you incurred, your accrual basis. But at the end of the day, the answer is always to almost all these questions is going to be that's up to your banker. Okay, recording this webinar, yes, we will. It'll be available online. We're also going to send an email to everybody. John Doe said that the 8-week window is being expanded to 21 or 24 weeks. It's not law yet. So my personal opinion is there's a good chance that's going to happen, but it is absolutely not law. What is law right now is the 8-week window. The only thing that has changed as a matter of law is the alternative pay period adjustment, so that you can, from the day you are funded, your 8-week clock can start to begin ticking on the first day of the following pay period. So that in and of itself could have a huge impact for some people. But as of today, it's not law. It is 24 weeks is in the bill that was passed by the House of Representatives. But from everything we understand and read, that bill is dead on arrival in the Senate. And so it's unlikely that bill in its entirety, of which this is a component, will get passed. But there's also plenty of talks in the oversight hearings that happened earlier this week, where this is a known issue, and it seems as though there's general support on both sides of the aisle. If I was to bet, I would predict that something's going to happen here, and that's going to get implemented. But again, that is for sure not the law today. We received EIDL. How does this affect our PPP? We did not apply for or receive EIDG. So we received an EIDG. I assume that means the EID grant, not the L for loan. So if you got if you apply for an EIDL loan, there's a checkbox where you can request a grant, where that's supposed to be a fast forward payment to help tide people over. It's kind of laughable because the SBA became so overwhelmed with this process that people didn't get their emergency money to tide them over for weeks, over a month and a half for an awful lot of people. But whatever money gets given to you as that advance, that is part of the forgiveness portion of the PPP. So again, the concept, you can't double dip from taxpayer funds. So the way the formula worked is if you would get $1,000 per employee up to $10,000. So if you had 4 employees, you would get a $4,000 advance, and that $4,000 would count as part of the forgiveness portion of your PPP loan. If you had 10 employees, or if you had 110 employees, you would cap out at the $10,000 grant, and that $10,000 again would count towards part of the forgiveness portion of your PPP. With PPP, even if your company is not significantly affected by COVID, can you still qualify for PPP? So this is probably one of the more controversial areas. It's certainly there are qualifications that you and we didn't go into all those, but we have them on our website. If you hop on the website, go to our assuresoftware.com/COVID-19. We have articles on this exact topic. Part of the hardship, so hardship is a gray area. So again, maybe you're that software company, right? That you can send your developers to work from home, so you can still do work, and maybe but you still could be impacted if sales are harder, right? Or you're still impacted because you can't get a loan from a bank to just operate your daily business. So there are several tests. What I would say is one of the important ones was access to capital. So if you're a company that you're an industry that is not heavily impacted, so you didn't take a giant revenue hit, but you have no access to capital because for whatever reason, whether it's bank covenants or your industry or whatever the reason is, you do not have access to capital, then you absolutely can still qualify. But if you're a company that has, this was the Shake Shack, right? So Shake Shack, there's this exemption. So it's just for companies under 500 employees. Well, they had over 6,000 employees. It was just under 500 on a per location basis, and they had $100 million in cash in the bank. So it was obviously not in the spirit of the law. But if you're a singular company under 500 employees and your revenue is impacted and or your access to capital is impacted, those are some of the major tests. So that can still be the case. All right, got time for a couple more. Is the EIDL loan forgivable? No. So PPP is forgivable. EIDL is not. That is a loan, but it's still relatively inexpensive money at 3 3/4% interest. I think 2 3/4 if you're a nonprofit, but it's a 30-year loan. So low interest, long time to pay back. The guidance we would give to any small business is apply for both by all means. Okay. I read something in the forgiveness form that spoke to the employee earnings not to exceed any 8-week period for 2019. Can you shed light on, what? I don't know off the top of my head exactly which section of the form you're referring to. Feel comfortable in the guidance we gave and the calculation of the rules, but we're going to go directly through the form next week. Can SBOs on the slide deck? We're going to send this recording out to everybody so everybody will have access to this information. For FTE calculation, what if an employee only works 12 hours? Well, I think the important thing is it's the compare. So if they worked 12 hours before the pandemic hit and they worked 12 hours after the pandemic hit, then they're whole, right? What the formula is trying to protect against is if you had a 40-hour week person who now works only 12, then in that case there would be penalty. All right. Let's see if I can take maybe 1 or 2 more. Apologies, there are tons here, a bunch of really great questions. I think a lot of these are going to get answered when we address, when we actually go through the form itself. If some employees are seasonal and are to drop off payroll May 31st, will this reduce the FTE count at the end of the 8 weeks? So when you review the link, so we'll send the link to the recorded version. When you review the deck, there are 2 periods. So you have two different options for a look back period, either 2019 or the same time period, or Q1 is your look back period. So if you're a business that is seasonal, you have it doesn't have to be just what you were just prior to the pandemic. It could be to the similar pay period of a year ago. So with the intent there being that you can have more of a realistic seasonal compare. So with that, I know we're at time. Tons more great questions. Hopefully we answered more than we created. This is fluid. This is changing like crazy. We're grateful for everybody's attention and hope everybody has a wonderful Memorial Day weekend. And when we get back, we will have our next webinar actually going step by step through the forgiveness application itself. So with that, thank you for everybody for your time and wish you the best.